The market has just wrapped up its final session of the week, and as of the close on Friday, May 22, 2026 at 4 p.m. Eastern Time, DataVault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, finished the day at exactly $0.4177 per share, down 8.6% during intraday trading from its market open price of $0.4391. To understand what is happening behind the scenes with this microcap stock, you have to look past the surface-level volatility of a 41-cent share price and examine a massive multi-billion-dollar corporate maneuver that just hit the wires. While retail investors are panicking over daily double-digit percentage swings, institutional players are tracking a newly signed binding three-part definitive agreement between DataVault AI and Wellgistics Health. This deal establishes a combined initiative called DelivMeds AI, an ambitious platform seeking to integrate distributed ledger systems, machine learning, and pharmaceutical distribution networks. The eye-popping detail here is the aggregate valuation of the combined assets involved in this transaction, which independent fairness opinions peg near $4 billion. For a company with a market capitalization sitting under $400 million, a $4 billion healthcare tech integration is an extraordinary development that represents an aggressive, sudden expansion into digital health services, final-mile pharmacy logistics, and the red-hot sector of medical weight loss product distribution. This massive structural pivot is precisely the kind of fundamental shift that retail traders using regular investing sites tend to miss until the price has already reacted violently. The standard market expectation for DataVault AI has been that it is an evolving penny stock trying to figure out its identity after rebranding from its former corporate title, WISA Technologies, back in February 2025. Mainstream financial media often categorizes it as a struggling small-cap firm burdened by heavy compliance costs, localized data solutions, and acoustic engineering patents that are difficult to scale. Retail traders looking for quick wins on a Robinhood stock trading app see the name change and assume it is just another microcap trying to ride the wave of technology buzzwords to pump its share price. The reality, however, is far more complex and significantly higher stakes. DataVault AI is actively building a massive data monetization infrastructure that bridges advanced machine learning models with real-world tokenized assets. By securing exclusive licensing frameworks like their expanded pharmacy chain platform that connects more than 6,500 pharmacies and 200 pharmaceutical producers across the United States, they are moving directly into enterprise-level utility. They are leveraging their core data valuation engines to automate complex back-end operations traditionally controlled by opaque middlemen, such as pharmacy benefit managers. When you look at the sheer scale of the network they are tapping into, the gap between what the casual public believes about this stock and the actual enterprise plumbing they are laying down is massive. When trading a hyper-volatile asset like DataVault AI, the execution platform an investor uses can completely dictate their success. Active traders moving large blocks of shares often look towards an interactive broker's platform due to its deep liquidity routing, detailed short availability tracking, and low institutional interactive brokers fees. When executing orders on a microcap stock under $1, execution speed and clear routing are vital to avoid heavy slippage, which is why a dedicated interactive broker's account is favored by the quantitative crowd. On the flip side, retail capital has poured into the stock via simpler online investing interfaces. Platforms like SoFi Invest have captured younger investors who utilize features like SoFi Active Investing to buy fractional shares or manage their portfolios through a broader SoFi trading platform. Many of these retail participants treat the company as a speculative lottery ticket, executing erratic buy and sell orders through a Robinhood app without looking at the underlying balance sheet or the massive float dilution. Meanwhile, long-term wealth accumulators who rely on traditional institutions for online investment help often hold these microcap positions as tiny, high-risk satellite positions within a broader self-investing strategy, utilizing a standard individual brokerage setup at legacy firms. To thoroughly evaluate the current trading dynamics of DataVault AI, we need to analyze the immense pressure the stock has faced over the last few sessions. Trading volume has spiked well above its 30-day moving average, driven by a combination of retail momentum, short seller liquidations, and institutional accumulation. The broader sector momentum in small-cap technology has been weak due to macroeconomic pressures, specifically stubborn inflationary indicators and the Federal Reserve signaling that interest rates will remain elevated for longer than anticipated. High interest rates act as a severe headwind for microcap companies that rely on debt financing or dilutive equity offerings to fund operations. DataVault AI is no exception, having recently completed a $60 million registered direct offering alongside securing $120 million in non-dilutive funding backed by Silex Holding. This capital injection is being aggressively deployed to build out a massive 48,000 GPU edge computing network, targeting more than 100 American cities. However, the immediate cost of this expansion has resulted in a staggering $53.1 million net loss in their recent financial disclosures, despite posting a massive 443% year-over-year revenue increase in the first quarter of 2026. This classic tension between explosive top-line revenue growth and deep bottom-line net losses is exactly why the stock experiences such violent intraday swings. Let us pause here for a moment so we can hear directly from the community tracking this asset. Please comment below how many shares of DataVault AI you currently hold in your portfolio, and let me know if you believe their $4 billion healthcare tech pivot will successfully clear their regulatory hurdles this summer. Understanding the underlying business model of DataVault AI requires tracking its operational evolution from its roots as an audio technology provider. Originally known as WISA Technologies, the firm spent years developing high-end wireless audio standards, patented spatial sound technologies, and data over sound protocols. This older segment of the business, known as the Acoustic Science Division, still owns valuable intellectual property, including their WISA-E and ADIO platforms, which enable secure data transmission and real-world asset tokenization via sound signals. The newer, hyper-growth engine of the company is its Data Science Division. This segment focuses on structuring, valuing, and securely monetizing massive corporate datasets. They provide proprietary artificial intelligence models that act as automated corporate valuation agents, allowing large organizations to treat their raw enterprise data as a tangible balance sheet without violating strict global privacy regulations. This operational pivot allows the company to operate across seemingly unrelated sectors, spanning from high-tech marketing signal analysis to healthcare compliance networks. The future outlook for DataVault AI hinges entirely on a few critical catalysts and near-term structural milestones. The most pressing risk hanging over the stock is a pending NASDAQ minimum bid price compliance warning, which requires the share price to sustain a level above $1 before the August 2026 deadline. To achieve this, management must successfully execute the national deployment of their DelivMeds AI platform, which is scheduled to commence its commercial rollout in North Carolina this July. If the platform shows immediate adoption across its connected network of thousands of pharmacies, the resulting transaction fees could rapidly shift the company toward operational profitability. Conversely, if the integration faces technical delays, or if the independent fairness opinion regarding the $4 billion asset valuation falls short of expectations, the stock faces heavy downward pressure and the realistic threat of a reverse stock split to maintain its exchange listing. Institutional investors tracking this through sophisticated systems are watching the company's projected fee pipeline, which claims around $750 to $800 million in signed tokenization contracts, expected to generate roughly $100 million in direct fees over the next 12 months. When you step back and look at the entire landscape, the central conflict with DataVault AI remains the stark contrast between public market perception and corporate execution. The broader market looks at a volatile sub-$1 stock experiencing massive net losses and assumes it is a failing venture facing imminent delisting. The deeper reality reveals a company aggressively restructuring its entire asset base, securing multi-billion-dollar healthcare partnerships, and building a massive distributed computing infrastructure funded by hundreds of millions in fresh capital. For investors utilizing a disciplined self-investing framework across major online investing platforms, this stock represents a classic asymmetric risk profile. The downside is clearly defined by the potential for severe equity dilution and execution delays, while the upside is driven by an enterprise data monetization model that could scale exponentially if their national healthcare deployment succeeds this July. Keeping a close eye on the weekly volume trends, institutional filings, and operational updates will be vital for anyone looking to navigate the volatile waters of this unique technology player. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video? Comment your thoughts. Outshare with your friends. Bell subscribe for more updates.